Have you been keeping up with the latest trends in the housing market? Despite some concerns about a potential collapse, recent data shows that the home market is actually holding strong as we head into spring. While there haven't been any major price changes, the market did experience a slight dip of 0.1% this year. But how significant is that compared to the massive fall seen since the beginning of the century? It's been about 3 years since the world was hit by a major economic event that impacted the property market in particular. Can you remember what it was? Based on the Case-Shiller Index, we've seen some surprising developments in the housing market in recent years. Did you know that the average cost of a home rose by a staggering 43% between March 2020 and June 2022? This was a remarkable rise that many experts never expected. While investors and owners benefited from the exponential growth, purchasers were left feeling dejected as prices dropped month after month. However, the market eventually leveled out in June 2022, and the Case-Shiller peaked this past summer. Despite these positive signs, prices have been declining for the past 5 months and are currently 3.6% lower than their all-time high. Some people consider this to be insignificant compared to past events, but the Case-Shiller Index would need to decrease by another 28 points before prices return to their pre-pandemic levels. What do you think the future holds for the housing market? Will we see a return to the pre-pandemic levels, or will prices continue to decline? On InvestWise, we provide you with all the information that you need to be on time with your investments. If you find it useful, please consider hitting the like button and subscribing. So, what's the latest scoop on the housing market? Interestingly enough, there has been a 3.6% dip in housing prices recently. This may not sound like much, but it could be an early warning of another housing downturn, reminiscent of the one in 2008. There's more and more data supporting this idea. For instance, the Case-Shiller report indicates that prices have been sliding for 5 consecutive months. When you step back, you'll see that this trend is quite unusual. Looking at the Case-Shiller Index dating back to 1986, the market has only experienced a decline of over 3% on 2 occasions, in 2008 and in 1990, when it fell by 3.05%. So, this seemingly minor shift in housing prices is definitely something to pay attention to. Some experts believe that folks may still be in denial after the last financial crisis, which could be why certain sellers hold out for higher prices even as the market shows signs of cooling. The housing market is a complex system, influenced by a multitude of factors, including the overall state of the economy, interest rates, and the supply and demand for housing. The housing market is also affected by construction companies' actions, which can significantly impact market pricing. Construction companies are major players in the housing market, moving thousands of units every month and employing entire departments dedicated to pricing. These companies have a financial motive to lower prices to clear inventory, as they better understand supply and demand dynamics than individual sellers. In the most recent quarter, many major builders slashed prices and offered incentives to entice buyers, indicating a shift in the market. While the Case-Shiller chart might not be a flawless indicator, recent earnings reports from builders reveal significant issues with the housing sector. These shifts will eventually have an impact, although it may take some time for the effects to ripple through the housing market. For instance, if you were considering buying a pre-existing property and a new property nearby suddenly dropped its price by 20%, it would likely influence your decision. The first homes built in a neighborhood often establish the price point for the rest of the area. Therefore, the actions of construction companies in pricing their properties can have a ripple effect on the entire market. In addition, the overall state of the economy and interest rates can also impact the housing market, as people's ability to buy homes is influenced by their financial situation. It's crucial to remember that a slowdown in the housing market doesn't necessarily mean a complete reversal of the progress made after 2020. Real estate markets don't crash all at once, and we can learn from the previous housing crisis to understand how it could unfold. In July 2006, the market peaked and then gradually declined over time. The housing market is also affected by demographic changes, such as shifts in population and the aging of the baby boomer generation. As baby boomers retire, they may sell their homes and downsize, increasing supply and potentially driving prices down. In addition, changes on immigration patterns can also impact the demand for housing. Technology is another factor influencing the housing market, as online platforms like Zillow and Redfin are changing how people search for and buy homes. These platforms allow buyers to view properties virtually and make offers online, reducing the need for in-person visits and potentially speeding up the buying process. The housing market is a complex system influenced by many factors, including the actions of construction companies, the overall state of the economy, demographic changes, and technological advancements. While a slowdown in the housing market may be cause for concern, it doesn't necessarily mean a complete reversal of the progress made in recent years. By understanding the various factors that influence the housing market, we can better predict how it will evolve over time. A little over a year after July 2006, the Case-Shiller index had only dipped by 1.9%. To put that into perspective, the decline in the last 5 months was greater than the entire drop during that year. By July 2008, 2 years after the peak, the decrease was only 10%, which wasn't too drastic. The index bottomed out in February 2012, after a 27.4% fall over 5 years and 7 months. It took another 5 years from the initial collapse to return to the 2006 peak, making the entire cycle last for 10 years and 6 months. I want you to grasp that the current dip in property prices is the outcome of a domino effect that started with builders and spread throughout the market until the excess greed was gone. It's not an easy ride. There will be ups and downs, along with moments of regret and greed. But now, the market has reached a critical juncture. For many Americans, the age-old dream of homeownership is threatened by the harsh reality of modern economics, the inability to afford a house. To back up my claim, I relied on data from the Census Bureau, the Federal Reserve, and the Department of Housing and Urban Development. Assuming a 10% down payment and the national average for taxes and insurance, I worked out the monthly cost to buy the median-priced house sold in each year since 1997, including PMI. Then, I took into account the median interest rate for each year and divided the total by the national average household income. Housing affordability has hovered around 39% for most of the past quarter century, leading up to 2008. This number shot up to 46%. As a result, traders, banks, and investors called it quits, leading to falling prices and interest rates. Post-2008 financial crisis, affordability climbed to around 35% before returning to normal levels. But then, in 2020, something unexpected occurred. The percent kept rising. By 2020, a home buyer in the US would need to spend over 52% of their pre-tax income on mortgage payments. We've already gone beyond the relative prices of 2008, which marked the country's largest real estate bubble. It begs the question, how is this situation different? It's clear that the current income, price, and interest rate levels can't maintain the status quo. It's only a matter of time before one of these factors gives in. From what we've seen in the past, earnings growth isn't likely to keep up with other economic factors. According to Jerome Powell, interest rates will continue to rise yearly. The big question now is, how much will this all cost? Unfortunately, things aren't looking great for the housing market either. Even though unemployment has been low and wages have been rising for the past 5 years, it's suddenly become almost impossible for most people to buy a home. This means that demand from regular folks like us is dropping, eventually leading to a price drop. This kind of thing usually takes a few years to become obvious, but there are some warning signs. For example, the weather this past summer was a lot like it was in 2006, right before the last housing market crash. We've already seen some major residential home builders slowing down, lowering prices, and offering more incentives to try to drum up business. All of this is leading many experts to believe that we're headed for a long, painful bear market that will start next year. So, if you're looking to buy or sell a home, it's important to keep all of this in mind. If you loved this video, subscribe, leave a like, and watch this one too.